Hey guys, this is Gabby from the Savvy Professor. In today's video, I will discuss the differences between qualified dividends and ordinary dividends. Watch till the end to know the final verdict on how they compare, but first, let's start with the differences. So the main difference between them is tax rates. The reason ordinary dividends are termed ordinary is because they are subject to regular income tax rate. For some, if you are in the highest tax rate, this might mean paying as much as 37% in federal income tax. A reduced tax rate, usually the long-term capital gains tax rate, applies to qualified dividends. Depending on your taxable income, the long-term capital gains rate can be anything from 0% to 20%. Therefore, the tax rate on ordinary shares is higher than qualified dividends. Therefore, qualified dividends are a go if you protect your money from high taxation. Holding period: if you held a stock for more than 60 days within the 121 days that started 60 days before the ex-dividend date, the dividend is qualified. If you hold it for less time than that, it is an ordinary dividend. The ex-dividend date is one trading day before the dividend's record date. The date a shareholder must be listed on the company's books to receive the dividend is the record date. Therefore, qualified dividends have a slightly longer wait time than ordinary shares, yet come with numerous benefits. Qualification: for dividends to be considered qualified, they must be issued by American companies openly traded on significant markets like the Nasdaq or Dow Jones. Some dividends aren't qualified for qualifying status, such as those from employee stock ownership plans or tax-exempt organizations, thus receiving ordinary dividends. Therefore, qualified dividends are flexible since they are openly traded. But do they have any similarities? Yes. Both are given to shareholders directly from a company's profile. Businesses that pay dividends set a fixed amount per share, which they might change based on the company's performance at each earning period, typically a calendar quarter. If a company's performance is good, the returns will be high for both qualified and ordinary dividends, and when low, returns will be low. To sum up, how do they compare? Qualified dividends or ordinary shares? What I like the most about qualified dividends is the low taxes they're subjected to. Low taxes give you a higher income than ordinary dividends, regardless of how high the business performed. Overall, I would choose qualified dividends anytime because of the tax exemption. Thanks for watching!